Thank you, Julie. I think this issue of fragmented markets, transparency, all very important. And up next, we want to dig deeper into the ETF market with topics around investment strategy, industry outlook, portfolio implementation. Now, I'll introduce my panel in a second, but please join me in welcoming them on stage first. All right, so I'm really excited of this panel of experts we have. So we have Bryon Lake, Managing Director and Head of International ETFs at JP Morgan, Debbie Fuhr, Managing Partner and Co-Founder at ETFGI, Dennis Dijkstra, Co-Chief Executive Officer, Flow Traders, and Thomas Merz, Head of Distribution, Europe ex-UK, Vanguard. All right, so we have, each year feels like a record year for ETFs, right? It's a nearly $7 trillion industry, 230 billion globally inflows just this year, 8,000, give or take, listed ETFs. So Debbie, if I can start with you, put you in the hot seat a little bit. So obviously some of the 8,000 cross-listed, but is that too many?
Well, I think probably some could say yes, but others would say no. It's just like the mutual fund industry. If you look at mutual funds in Europe, we have a lot more mutual funds than there are ETFs. So it's not surprising that when issuers come to market, you want to have a core family so you can get on the select list. So I think some say yes, but I would say there's still opportunity because where and how people are investing is changing. And as new issuers come to market, they're looking at ways to offer their intellectual property and skill within the ETF wrapper. And it's important to remember ETFs are really just a mutual fund with added benefits.
So, Bryon, obviously you are on the front lines of this. So from JP Morgan's view, is the era of the so-called, spaghetti cannon, throwing things against the wall, seeing what sticks over, and what is JP Morgan concentrating on for this next leg of growth?
So I'll just continue on and Debbie's question and then answer that as well. So, one of the statistics I always point to is that there's more mutual funds in the US than there are individual securities. That's true here in Europe as well, obviously with share classes and everything like that. So I think that just helps put everything to perspective. I think what we've seen through the ETF industry is a healthy evolution, but what we're seeing in many different areas and industries right now. And so I don't think that in a decade ago, product development groups within ETF providers were thinking they were just firing spaghetti. I think what they were trying to do was provide as many tools for investors to build portfolios as possible, and that was kind of a rapid fire bringing product to market. What I think we're seeing now, and particularly the way JP Morgan is thinking about it, is we're actually looking at the ETF wrapper as a technology. And thinking of it just as the wrapper. Most kind of folks refer to ETFs and passive and index kind of synonymously. And we want to pull that conversation apart. We want to say the ETF is a technology, and then what you put inside of that is the investment engine. And so, yes, indeed, you can put index in there, you can put factor or smart beta, or as you'll see with JP Morgan, we're putting active capabilities within the ETF wrapper. And we actually think this is a really interesting innovation that's happening in the industry.
Thomas, if I can kind of continue on that line of thought. So, okay, you have all this innovation coming from JP Morgan, coming from Vanguard, but still we see the majority of flows going to the cheapest ETFs. Is this a problem? Does this mean that the strategy of assessing these ETFs is broken for a lot of investors?
No, I don't think so. It's broken. I would like to take kind of a step back. Yes, we definitely have seen a trend of the new money flowing into kind of ETFs which were either new or repriced. However, there is a kind of a legacy book of business or assets in very old and long-standing ETFs, which are priced quite on the higher end, which gives us the kind of average of around 20, 25, 28 basis points, which if you compare with newer products come to market with single digit and low double digits number, you can understand that kind of dispersion, right? But yes, what we have seen is that prices come down because also some of the ETF issuers, probably including Vanguard, kind of pool the assets and get economy of scale, which then allows to come down with prices. However, I do think, as in particular in Europe, and I'm talking about Europe, and I hope you can confirm that, clients are professionally buyers. They're by large not retail buyers who are overwhelmed with those technical details, who are not, like these buyers are not overwhelmed to have a really solid due diligence process, which they pick quality versus price. I mean, that's definitely the case. So they are not fooled just by shiny prices and maybe the index is not properly managed or the index is the wrong one, right? I think that's where I really see some concerns, which we share as Vanguard, but I personally share that yes, you can wrap it in an ETF and view the ETF as a delivery mechanism to various investors, but however, you need to explain what's in there, right? And that's probably my observation over the last decade is this effort has risen. For me, it is really a big effort to explain to various clients, okay, this index, what does it do, what does it include, right? Starting with emerging market and ending by factor ETFs, That's a whole slew almost of products. And that's our concern, the proliferation of products. Not the sheer number, but the kind of variety and using different names for similar things, right? We have to kind of bear that in mind.
Dennis, I want to get your thoughts on this because from not a provider point of view, but obviously seeing where flows are going, seeing where the industry is, and Debbie, I'm going to throw this to you as well. I mean, if you were to give advice to Thomas and Bryon at their respective companies, you're coming in as a consultant saying, here's what you need to do in Europe to help get that retail audience on board, what would you say?
I think it's about the market structure itself, the microstructure. I think we had a panel just now explaining how the market structure and the regulation works. I think I didn't really understand it. It's so complicated, and especially if you compare it to mutual funds, you just wire some money to an account and it's done. And I think part of the fact is that the reason of the success is because it's exchange traded, there's transparency about pricing, it's liquid. It's also, the flip side is, it's very complicated. So if it's trading at a premium or not, what's the INAV, and investors get puzzled. So just do me a simple product, make it very simple to invest in. Because I do agree, I think there is, although retail investors might invest in it, I think they're still clueless what an ETF is, how it works, what the different issuers are. So also they're educating the retail investors. But I think especially it's about the wealth managers and the asset managers who are investing in these products. And I think, but also I think the ETF open ecosystem has brought a lot of advantages. So I think the MTS and the RFQ platforms like Bloomberg, RFQE, have given also access for the buy side directly to the liquidity providers. And so a big part is there is transparency, it's very efficient, very low cost. Also, why should an execution desk pay commission to do a trade? I think there's been some research that on average still 3 basis points get paid. We're not making 3 basis points on the trading we do. And we take on the principal risk. So also there's so much more education to be done and to get investors comfortable. And I think especially the big issuers, because this is a scale game in the end, also for firms like ourselves, they have very sophisticated capital markets or execution desks, which help investors really searching for the best liquidity out there. So it's really simplifying the infrastructure, or at least making it simple to the buy side, whether it's institutional, retail, or whoever. And I think there's still quite a long way there to go, unfortunately.
And Debbie, and I'm also curious because obviously infrastructure, big part of this, but just are providers doing enough to educate, or do you think that the audience is pretty, not this audience specifically, of course everyone's educated here, but the ETF audience is pretty educated and knows what they're doing?
Well, I think the challenge is it is market structure, but the unique thing about ETFs is it's a very democratic product. So you'll have very sophisticated hedge funds and pension funds using them. You'll have financial advisors and then retail. And so how you talk to these different audiences is different and what they need to understand. And so I think sometimes we're talking at a hedge fund level when we're talking to retail, which makes it too complicated. And the other big challenge is if you look at the platforms that held mutual funds, most of them don't today have the technology to trade ETFs. And so they say, well, there's no demand, so we're not going to offer ETFs. So market structure is a big issue. And I think, as we've heard, education. So helping financial advisors really understand ETFs. I've been involved with ETFs since '97, and even coming here to Amsterdam back then, many people would say to me, are you going to pay me rebates? And I'd be no, and they'd say, well, don't come see me. So I think the reality is many people have not wanted to embrace ETFs, but what you find is once you compare them to other products, today we see ETFs being more cost efficient than using futures if you don't want leverage. So it's really peeling back the onion to compare like for like. And once people try ETFs, you tend to find that they'll use them more, they use them in larger sizes, and they hold them for longer time horizons. So half investors hold them for 2 years. So I think there's a lot of misunderstanding that everyone trades ETFs in 4 hours or holds them for 4 hours or whatever. So it's really doing the due diligence to understand them and not viewing them as, I'll never use these things. I'm not thinking that people in this room feel that way, but many financial advisors have felt that way. And so it's really opening people's eyes to understanding how they might be useful.
Yeah, I'll add to that, and just for clarification, my name's pronounced Bryon. You can thank my parents for that. If I say anything stupid, you can attribute it to Byron. And I've never seen that guy before, but he's done a lot of really, he's made a lot of mistakes in his life. But anyways, I'm Bryon, never made a mistake because that Byron guy screws it all up. But I'm going to play off what Debbie said and what was mentioned earlier and remind us all of how technologies get adopted. Right, and so we've all got a phone in our pocket right now, and we probably have downloaded music on that phone within the last week or 2 weeks, or maybe even streamed it, right? But do you remember the first time you downloaded an MP3? Right, you probably stole it off Napster, first of all, so shame on all of you. But second of all, you had this little MP3 player that would hold like 11 songs. And you had to plug it into your computer, and then you'd download the song, and then you'd move it over, and then you'd go like that, right? It was complicated, but your first experience with it was, this is the future. That was your experience. You said, this is a new technology. This will be how I listen to music in 5 years and 10 years. And that's the experience that ETF users, the journey that ETF users go on. The first time you trade, you're like, wait a second, I gotta think about what the intraday price is, how this works. I got a lot of these pieces going on. But then you do that trade and you're like, this is the future. Now I understand how I'll be building portfolios for the next years going forward. And that's, I think, the journey that investors are on right now, is this education process, this adoption process where you're saying, oh, like now I get it, right? And so there is some complexity behind it on the capital market side and how the trading and all that works. But there's also some beautiful simplicity in it, in the sense that we could all pull out our phones right now, pull up any ETF, a JP Morgan ETF or a Vanguard ETF, and see the price that it's trading at right now, real time, right? And we could watch a headline go through on Bloomberg TV right now, and we could see exactly how our ETF price has changed based on what's happening in the market. That's a technology that I want. That's a technology that if I'm a portfolio manager, if I'm a fund-of-fund manager, if I'm a private bank discretionary account manager, I want to have that availability, that real-time information to be able to build better portfolios with it. And so, yes, the adoption is early. Yes, as with everything, when you're adopting a new technology, there are some things to learn. But once you've traded one, you'll say, yes, this is the future of how I will build portfolios. And that's the journey that I think we're all really on right now.
I think just to add on that part, because listening to my colleagues here on the panels, sometimes I think like it sounded like we're all talking about IFAs and end investors and investors who are just starting to build a portfolio. But in Europe, that's not the case, right? As you mentioned, I mean, ETFs are heavily used by very sophisticated portfolio managers. And I think one reason this kind of took that route and not an retail, more IFA route, is because, first of all, market structure, and secondly, kind of the growth of, let's do model portfolios, multi-asset portfolios by one portfolio manager, but he's not an expert everywhere, right? So he was actually on that search for a very convenient-based instrument, which has all these advantages and is easy to handle for him. Like for me, it was always that's the convenience play in a very sophisticated framework, right? Of a very sophisticated asset manager, but he uses here and there, not for the whole portfolio, but he uses here and there ETFs, which just gives them quick access, direct access, very cheap access, right? Where he then focuses on other areas of his expertise and can, kind of show what a great portfolio manager he is.
Sorry, go ahead.
Well, I was going to say, I think it's also moved on because related to that is a lot of asset managers historically used mutual funds and looked for active managers. And so what they've found is if you look at the SPIVA study and you say, okay, I'm going to put money in the US since it's about half the allocation of MSCI World, you find that 82% of active funds on a 3- and 5-year basis are not beating the S&P 500. So people have moved from where can I find good active funds? Can I find good hedge funds? When can I deliver alpha? To looking at low-cost beta products often, sometimes active though, but mostly low-cost beta to generate alpha through asset allocation. And so I think that whole challenge of where is alpha sitting and where can I find it consistently has driven many people to move to ETFs. And so I think that's what caused many pension funds. I mean, the biggest ones here in Holland used ETFs back in '97. So I did drive the stop train, well, I didn't drive it, but took the stop train to many places and people used them a lot, but selectively.
So I want to get really specific here when we talk about use. If you could, I'm interested to hear whether you've seen it personally or just something you thought of. What's the most innovative, interesting, surprising way you've seen an ETF be used? And throw that out if anyone can think of any interesting things.
Yeah, this is also a bit about the customer experience, right? Because I fully agree, right? It's very easy to see what the actual, let's say, microsecond valuation of your portfolio is. So we see in China 2 of the big money market ETFs. People are using them on their phone to move money from their current account, where you get no interest, into the money market ETF, just with a swipe on their phone, right? So moving back and forth if they buy stuff. So that's the actual retail experience. And these are massive funds. So also there, I think, and that's where the future will be, that people have their portfolio themselves on their iPhone, switching back and forth, or any other telephone. That's the future. But I think currently we're still in a world where a big part of it is managed by different people. So also I think that's, but the world is already there in some parts in the world already. So
I'm happy to add on to that, and I'll just kind of pull on some of my experience from the U.S. markets where I've spent some time, and then I've been here in Europe for the last 5 years. But there was this aha moment that happened in the U.S. when investors, relatively sophisticated investors, asset managers, but also discretionary portfolio managers, they were looking at, I won't say the competitor's name, but another asset managers, and they had a very famous global allocation fund, let's say. And if you looked at the back of the brochure, it was a pie chart, and it had all the different slices of the portfolio: emerging market equity, U.S. equity, mid cap, small cap, right? And the light bulb went on, and they said, wait a second, instead of paying them 2% to do this, I could look at this whole list of ETFs where the supply is completely unlimited. I can get as nuanced as I want, or I can be as broad as I want. And I could recreate that just by buying 15 ETFs and building a portfolio on that. And by the way, all in, my expenses have now come down to be a third of maybe the price that I had there. I have a much better feel with what's in the portfolio. I have full transparency on what's in the portfolio, so I can further articulate the risk and what the underlying holdings are there. And so it's a slightly different, maybe the other end of the spectrum of what you're mentioning, which I think is also an unbelievable evolution that we're seeing unfold before our eyes. But the notion that, wait a second, I can get exposure to this, and I can use an ETF tactically for the next 6 months to hold this exposure, maybe cash equitize, and then rotate into a different option is, or investment capability is one of the things that I think we're seeing.
Would you say there was some parity of risk in that allocation?
Yeah. But
no, I'm just trying to pan you. Yeah,
you're poking
Thomas, Debbie, any interesting uses you've seen of ETFs?
No, I probably just want to add to this kind of thought. It is the way the convenience play works with ETFs, and I've seen portfolios, entire portfolios from, very sophisticated asset managers to switch either entirely into using ETFs, and probably not even 14, like 5, and on other occasions just part of it, like by like that, right? And big bulks, like big assets being switched to ETFs. Sometimes, as you said, tactically, and then moving out again. You know, it's kind of equitizing, or just, you know, kind of until the new strategy kind of forms, or it's really kind of to adjust to the CIO's call. I mean, we all, you know, as portfolio managers, we are all kind of in that framework of a CIO who, you know, asks to go U.S. equity down by 0.5%, or emerging market going up to neutral, right? And that in this scenario, ETFs really play their whole strengths, because it's easily done, directly implemented, and you're spot on your strategic asset allocation.
Yeah, I think if you think about institutions and the way they've used them here, quite often when an institution decides to get rid of an active manager, I've seen them park the assets in an ETF, do the beauty contest, and then unwind it to the portfolio that they might want to give to another active manager. I think if you think about broadly understanding ETFs, I think the advent of robos has actually been a very useful tool for general people to understand asset allocation. And because ETFs are inside of it, I think it's raising the awareness of asset allocation, how to invest, where to invest. And I think with MiFID II, that is an important change, because many people didn't realize they were paying an advisor before. Now they don't want to pay. And so I think that the robo has become, many people don't like the term robo, but I think it's become a useful tool globally to help people think about investing and how to invest, and to be able to have a conversation. But when you look at institutions, I think using ETFs instead of futures, using ETFs to easily get exposure to China A shares, emerging markets, play tactical allocations to Japan or things that are happening, that's the beauty of ETFs. You can use them to equitize cash tactically and long term. And so there's been a lot of interesting trades that have happened where people are saying, you know, I don't want to manage a large bond portfolio in-house. I can do it with an ETF for 20 basis points. And I don't have to worry about duration or, you know, investing against what today used to be Lehman, Barclays, Bloomberg Ag. ETFs have just made it easier for you to focus on other things that take up time.
Yeah, and I think investment strategies are evolving as well, with more information that's becoming available. So you've probably seen headlines recently of some big institution X that's getting rid of all of their hedge funds, and they're going to go to more of a liquid alternative type solution because of the usual suspects, right? Like the fees are too high, or maybe performance isn't there, or they don't like the lockups, and some of these types of reasons that we tend to hear. Well, and just to give a specific example from JP for a second, so we've taken a very successful liquid alternative strategy that we've run for over a decade, and we've broken it into standalone ETF strategies. So we have a managed futures and an equity long short strategy. These are very liquid strategies that tend to be set into the alternatives bucket, but can be done in a very transparent and liquid way. And so we've actually wrapped some of our flagship strategies that again have almost a decade's worth of history into the ETF wrapper, and we're seeing institutions say, well, wait a second, why would I pay 2 and 20 over here when I can get what I'm looking for on the alternative side of non-correlated investment returns, something that can generate alpha, something that could potentially buffer my portfolio if there was a drawdown in the overall markets, but I can do that for, you know, 57 basis points TER all in, right? And so these are the types of things that are happening in the investment industry, where with the data that's available and the way that we can deliver these capabilities, we're actually saying, no, we can deliver that in a very scaled way at a very attractive price point, vis-a-vis kind of a 2 and 20 strategy, just as another example.
Yeah. You know, we probably forgot one thing here, which goes back to your question. When I saw, you know, how easy it is on the fixed income world, which is in some instances still a very difficult market to access, right? Not the govies, but, you know, some more into credit. I think what ETFs brought to the table there is amazing. Is amazing. And I've seen weighted basket spreads of 35 basis points. In an ETF, it's 11. Like, this is exactly where ETFs bring the added value to the table. They're traded below the weighted basket spread. They're one line to book, right? And you get access to it. I mean, that's, I think, you know, brings even more the strength of ETFs. And that's why they're so in demand, because they really provide easy access to asset classes, in particular in the fixed income space, where it's very difficult lot size, right? Execution, it's still OTC, but here you book you have it, right?
Right.
I think that's the real shine of ETFs.
But with a lot of those products, though, we are looking at relatively, at least compared to equities, illiquid markets. When you're thinking about fixed income, Dennis, I want to bring you into the conversation. Are there any ETFs, be it 3 times levered inverse oil, what have you, that because it's so easy to trade that, investors are overlooking the risks of the underlying?
I think the liquidity of the ETFs is based on the liquidity of the underlying. So that's a reflection, so a direct relationship. And the good thing is, I think today there are many liquidity providers like ourselves who can give liquidity for very big sizes. And so trades of over $1 billion are not on daily, but very regularly. So also there with a minimal cost impact. So I think that also says whether it's fixed income or equity or commodity related or any other asset class. So I think that the investment vehicle of an ETF is very, very efficient to give you access to even big exposures just in an instant. And whether the underlying markets are closed, so it also gives you access to, let's say, other regions, other asset classes, which were very difficult to get access to at a very minimal cost. So as said, especially for fixed income, this is also a real game changer. If you see the spreads for even big corporates or high yield fixed income ETFs, I think the spreads are very narrow. You're well diversified, so it's way more efficient. And in the end, also it will help the yield for the investors, because moving in and out regularly really also drives down the return.
I want to add on what Dennis is saying there, because I think it's an important point. Again, to demystify this a bit, ETFs, the vast majority of them in Europe are UCITS funds that we're all using every single day. And all of the ETFs have daily liquidity, just like most UCITS strategies. So if you were using a high yield bond mutual fund that was a UCIT and you see it in an ETF, it still abides by those kind of same regulations, right? What an ETF brings to the equation is we've now introduced secondary trading, which is a fancy way of saying on-exchange trading, where if this side of the room was buying and this side of the room was selling, you all could meet at the exchange and trade with each other, as opposed to everybody having to send it into the issuer and then us dealing with sending it back out. So we've not created more liquidity, but we've made it more convenient for liquidity to meet at the right spot. So that's what's happening with ETFs in general. Now on the fixed income side, again, using the high yield bond example, remember, if there wasn't that secondary liquidity, it would just come to us as the primary issuer, and in that instance, we as JP Morgan or Vanguard or any other issuer is going to treat it almost exactly like we would any other mutual fund. And so the mechanism is all the same. It would still just go through our dealing desk. We would take our bond traders or the portfolio managers, and they would just trade it with some of the most appropriate market makers in the industry. So I want to demystify that ETFs are like creating this liquidity out of nowhere. That's not true. What they are is they're as liquid as their least liquid underlying holding, i.e. the underlying holding is what drives the liquidity. But we've increased the convenience by putting it on the secondary market. If it's okay, I'm going to stick with fixed income just for a second, because I'm quite passionate, and I think there's an opportunity here for investors. So if you look at the European fund landscape, so not ETFs, but if you look at mutual funds, the assets are 2/3 in fixed income, 1/3 in equity, just to use big round numbers, right? If you look on the ETF side, it's the other way around. It's 1/3 fixed income, 2/3 equities. I don't think investors have fully appreciated how game-changing it is to get fixed income exposure through the ETF wrapper. All the things that have been mentioned, the diversification, the intraday liquidity, the really efficient spreads because of the mechanism and the traders that can package these things in an efficient way. Those have not been fully appreciated by investors yet, and I think will be the next leg up in this market. I think, as Debbie points out on ETFGI, global ETF assets are $5 trillion, as she likes to point out. That's bigger than the global hedge fund industry. But if you talk to most of us, we think that'll double over the next 5 years. And in fact, I think that the ETF industry will grow to $30 trillion by the year 2030. And I actually think that there's numbers to get there. I'll show you the math afterwards if you want to take a look. And I think the vast majority of or a big chunk of that will be driven by fixed income ETFs, because I do think it is such a revolutionary technology.
So I feel like we've only just scratched the surface here, and unfortunately we only have a few more minutes left. So the way I'd like to end it, if possible, and again, sorry for putting everyone on the hot seat here, but you agreed to come up here. In about 30 seconds each, I want to hear, if I gave you just $10,000, some play money, what ETF are you going to put it in?
Wow.
You can give me the kind of ETF. You can market a JP Morgan or Vanguard ticker. Just tell me where you're going to put it.
So we of course can't give investment advice or tax advice, but something to consider. Maybe so one of the things that we've done that I think is quite innovative is we've launched an active capability based off of JP Morgan's liquidity business. So we've got the biggest liquidity business in the world, give or take, about $600 billion. And we've actually built a step-out product, so a managed reserve plus product. And we're seeing investors think about cash as an asset allocation play again. And so we've done a suite of ultra-short products that have durations of less than a year. And so what we're seeing investors do is if they have kind of cash on the sidelines where they're looking for more yield, they're stepping up their cash to this ultra-short product, which gives a pretty significant uplift in yield. We're also seeing people step down from kind of the traditional ag and use the ultra short. So it's kind of uniquely positioned. He's officially cut me off. It's kind of that was my 30 seconds. It's uniquely positioned to do that, and I think it's an active capability where we have a portfolio manager with discretion on the portfolio. So I think is again extremely innovative in the industry and is worth a look.
I guess if I had play money, and again, I'm not going to give you advice here, but I would put it in emerging markets with an extra top up to China A shares.
Yeah, we probably have a bit of a different kind of stand. Instead of throwing out some ticker and names, we believe that you need a broad diversification. Very simple, right? Broad diversification. You need to not tactical call here and there and going emerging market and not. So our view, Vanguard's view, is actually stick to an all cap, all market, and be very boring with it and just get the whole market in one ETF, if that exists. Doesn't exist, but maybe two, on the fixed income side, equity side, and that's it, right?
Bogle would be very proud of that answer. Right, Dennis?
Yeah, again, I think we're all very rational people, so I think there again, that's why probably you're in this industry, first of all. So it's going to be a very well diversified equity, fixed income, but also some other assets, right? So whether it's commodity and perhaps in the future some crypto or blockchain-related ETFs for some additional yield or not. So it's going to be well diversified, but it's going to be in ETFs anyway.
Wonderful. Well, thank you all for joining us, and I hope you guys learned something.